You see a company report a huge profit, right? But have you ever stopped to wonder how that number actually turns into their tax bill? Well, in this video, we're going to crack that exact code. We are breaking down current income tax, what it is, how it's calculated, and how companies figure out what they owe the government right now. By the end, you'll know how to move from accounting income to taxable income, handle tax losses, and prepare journal entries that show up in real-world financial statements. Before we start, don't forget to hit like and subscribe. It helps more accounting students find this kind of content. So how do we get from that big pile of profit to the actual formal tax bill the government sends? It's definitely not a straight line. There's a whole process of adjustments and translations to get from one to the other, and we're going to walk through it step by step. Okay? First things first, we've got to understand that companies basically speak two different languages when it comes to profit. There's the language they use for their shareholders and investors, and then there's the language they use for the government. And believe me, they are not always the same. And here's where it all starts. On one hand, you've got accounting rules. Think of these as the rules for talking to investors. They're designed to give a fair and consistent picture of how the business is doing. But on the other hand, you've got the tax rules dictated by the Income Tax Act. Their goal's completely different. It's about collecting revenue for the government. Because they have different goals, they often count income and expenses in totally different ways. This brings us right to our main event, current income tax. All this means is the tax a company has to pay for this year. And here's the key part. It's calculated using the number from the tax rulebook, that taxable income, not the accounting profit that everyone sees in the annual report. So how do we bridge that gap? How do we get from one number to the other? Well, we use these things called translation adjustments, and they come in two main flavors: permanent differences and temporary differences. Let's dig in. First up, we have permanent differences. The name kind of gives it away, right? These create a gap between your accounting profit and your taxable income that is, well, permanent. It's an item that hits one set of books but will never show up on the other. It's a one undone kind of deal. It will never, ever reverse. Let's look at some classic examples. Take golf club dues. For accounting, a company might say, hey, that's a legitimate business expense. But the tax authorities, they look at that and say, nope, sorry, you can't deduct that. So that expense is just gone for tax purposes. It permanently increases the amount of income you'll be taxed on. Now, the other side of the coin is temporary differences. And these are all about timing. It's not if an item will be counted, but when. These differences pop up because the accounting rules and the tax rules decide to recognize income or an expense in different years. But, and this is crucial, they always eventually reverse and balance out over time. A perfect example is depreciation. Let's say you buy a big piece of machinery for your own books. You might spread that cost out over 10 years, but the tax rules have their own system called capital cost allowance, or CCA, and it might let you write it off faster or slower in any one year. The numbers are different. But here's the thing, by the end of that machine's life, you'll have deducted the full cost on both sets of books. It just evens out in the end. Okay, theory's done. We've got the building blocks. Now let's get our hands dirty and actually run through a calculation. We're going to see how a company's book profit gets translated into its taxable profit in the real world. It's a pretty straightforward process, really. Step 1. You start with your accounting income. In this case, a nice round $100,000. Then you add back those permanent no-nos, like the $10,000 in golf dues that aren't deductible. Next up, the timing stuff, we add back the accounting depreciation of $25,000. And then we get to subtract the tax deduction, the CCA, which is $30,000. And voila! You do the math, and what do you get? We started with $100,000 in accounting profit, but after all those adjustments, the final taxable income is $105,000. This is the number that matters to the tax authority, so we've got our magic number, $105,000. What's next? Well, you'll be happy to hear the hard part is over now. We just have to apply the official tax rate. So let's say the corporate tax rate is 25%. We take our $105,000 of taxable income, multiply it by 25%, and we get a current income tax expense of $26,250. That is the company's official tax bill for its operations this year. But wait, we're not quite done. Just because you've calculated the total expense doesn't mean that's the check you write at the end of the year. We have to talk about how this bill actually gets paid. You see, companies don't just wait until tax day to pay one giant bill. That would be a nightmare for cash flow. Instead, they make regular payments throughout the year called installments. So at the end of the year, it's all about squaring up what they've already paid against what they actually owe. Let's go back to our example. The total tax bill we calculated was $26,250. This company was on the ball and already paid $25,000 in installments. Simple math, right? That means they still owe a final payment of just $1,250. Now, if they'd overpaid, of course, they'd be getting a nice little refund check instead. Okay, we've been all about profit so far. But let's be real. Businesses sometimes have a tough year. What happens if, after all those adjustments, you end up with a tax loss? Well, believe it or not, that red ink can actually be pretty valuable. A tax loss gives a company two really powerful options. On one side, they can carry that loss back up to 3 years. They can apply it against profits they made back then and get an immediate tax refund that's cash in the bank right now. The other option, they can carry it forward for up to 20 years to reduce taxes on future profits. It's kind of like a tax-saving coupon to use down the road. So let's just do a quick flyby of the whole process one more time. You start with your accounting income. You adjust it for both permanent and temporary differences to get to your taxable income. You hit that with a tax rate to find your tax expense. And finally, you settle up that amount against any installments you've already paid. That is the A to Z of current income tax. And that brings us to one final huge question. We set those temporary timing differences eventually reverse, right? So what happens on the books when they do? Well, that is the perfect setup for something called deferred taxes, where the story of those timing differences continues. We'll be tackling that in our next video. Thanks for watching, and I'll see you in the next lesson, right here on Canada Accounting Insights.